What is a SSAS? I found over the years that to describe a SSAS is actually better to draw a SSAS. Most of the directors and entrepreneurs that we work with really appreciate sort of the visual aid to see how a SSAS works. And so we're going to do that for you now and show you how a SSAS is set up, works, and some of the things that you can actually do with it and the tax breaks that it actually gives you. So here we go. So as you may have gathered from videos, you have to set up the SSAS generally under a trading limited company. So it must be active. There is no minimum time for it to be going, but ideally we need at least 6 months, and we'd have to have management accounts with it as well. So in this particular example, with a limited company, I'm going to assume it's a husband and wife arrangement, which is probably the most common type of limited company we end up using for SSAS. So SSAS is a pension scheme of the company. So it is the company that sets up and sponsors the SSAS. So the SSAS is just a great big box and nothing more than that. It is that simple. When we set up the SSAS, we'll put in both the husband and wife because they are the directors of the company. So we have 2 members of the SSAS. So you can see we're in the same box here. We have the husband and we have the wife. Now when we set up the SSAS, and once it's approved by HMRC, then the SSAS has its own bank account attached to the SSAS. It's just a current account, nothing more. So once it's established, the members have lots of decisions to make. They are the members, they are the member trustees, they are in control, which again is what most of our directors quite like to have. So they have to run the SSAS with £1 Crown's support. So they have the company, and let's take in this example, the husband and wife decide that they want to make some corporate contributions into their pension. They are directors of the company, and the cash flow in the company permits to allow them to do, say, a £60,000 contribution each. So that will be £120,000 of contribution made by the company, which should be available for a corporation tax deduction and save tax of £30,000 based on the company paying corporation tax at the 25% rate. Now, obviously what we haven't done here is looked at the ability to carry forward unused allowances from previous years, and we'll cover that in a separate video. So here we have, they've each put 60,000 in. So at £1 Crown, what we do is we add £60,000 on our spreadsheet for each member of the SSAS. So we now have £120,000 in the SSAS, and this is in effect a pooled vehicle. So the husband and wife directors are now working together to use that £120,000 to purchase investments or whatever they decide they want to do with it. So just quickly looking at the tax aspect. So one of the joys of having the funds inside this SSAS box is they're exempt from a number of taxes. So obviously if they invest the money, that growth is statutorily exempt from capital gains tax or CGT. This could be a big thing. A lot of the CGT allowances have been reduced or removed completely. So having somewhere that you don't pay capital gains tax is an absolute must these days in the UK tax system. One of the other big advantages is, and one of the things that SSAS gets used a lot for, it is also exempt from inheritance tax or IHT. Again, any assets, cash held inside the SSAS or outside your estate for inheritance tax calculation purposes. So again, this is probably one of the best IHT planning vehicles that you can lay your hands on, because the minute you put the money in the SSAS, it is out of your estate day one. There is no 7-year runoff rule. or any of the gift rules or any of the trust rules. And again, with IHT, there are no later tax rules to the money that is held inside SSAS. So again, this is absolutely probably one of the best planning vehicles that you can use to mitigate IHT. An additional feature of having put funds into the SSAS is that funds held inside SSAS are also creditor protected. And that can be very important, particularly when it comes to buying, say, commercial property that the business may want to trade from. So you have got creditor protection, providing, of course, you haven't put the funds in there to avoid creditors, which would then be obviously disallowed. But if you're in the normal trading sense, putting money into the pension scheme, that has got full creditor protection for you. So see, we've got creditor protection. Now, one of the advantages of SSAS is you can have up to 11 members. What we try to say to everybody is, please keep it in the family. So in this particular example, we've got a husband and wife. Okay, so what we found obviously is that the SSAS is exempt from capital gains tax, inheritance tax, and it obviously got creditor protection. But of course, one of the other advantages of having a SSAS is that the investments you make pay no tax on the profits. So no tax on profits. So in effect, no income tax is due or corporation tax is due on any profits that you may make on the investments that you have inside the SSAS. So it's effectively a completely tax-free zone, which is absolutely fabulous. Okay, so that's just setting the SSAS up. That's making contributions, attach the limited company. You can see how it works. All the funds flow through the SSAS bank account, and we make a note of what everybody has contributed to the SSAS in terms of the contributions that come from the company. You can also make personal contributions to the SSAS should you wish to do so, and there are occasions it is actually materially advantageous for you to make personal contributions, particularly if your income for whatever reason is between 100 and 125,000 where you're in the tax margin. So again, making personal contributions might be well worth looking at, but those are something that's to discuss with us, and we'll work out the optimum place to take contributions from. But in the vast majority of our SSASs, it is usually corporate contributions. Okay, if we move on, so you can see how it looks when we've set it up. Now, move it on a little bit. If this husband and wife have, say, 2 children, then it is possible in the future to bring your child into the SSAS once they have reached the age of 18. So you can make your children members of the SSAS. Now, one of the things here is they do not have to be employed by the sponsoring employer to become members of the SSAS. You can just put them in. There is no requirement for them to have contributions. However, if we assume in this particular example that they do employ both of their children in the company, then the company can also make contributions for the children. Again, the amounts you can discuss with us. Needs to be sensible, particularly if they're not directors, which one would assume they're probably not going to be in the early years. But certainly the company can make contributions for the children. And again, those contributions are a tax deductible expense to the company and will save further corporation tax. Okay, so in the first example, we've seen how the SSAS is actually set up. We have the sponsoring employer establishes the SSAS. We had the husband and wife as the directors, and obviously we've looked at the tax savings that you can make. So let's go back to the drawing. We've got, as we did in the first example, the limited company, and the husband and wife are the 2 directors. This is probably one of the most common we see. The limited company sponsors the SSAS. As I say, it is just a great big box, nothing more. So husband and the wife. And if you remember, the company made contributions on which it received a corporation tax deductible expense. So we've reduced the corporation tax in the company. So that's the setup. And if you remember, there was a bank account set up that's attached to the SSAS, and all funds must flow through that bank account, so it creates a full audit trail. And that's part of what we do. We maintain the bank account for the SSAS. That's what my staff do, so that we have full records of what's gone inside the SSAS. And you get a copy of that every year, by the way, as well. So we've saved a whole load of tax. We know this is a great big tax exempt zone, which is absolutely fantastic. So the second stage is now to, what do we do about investing the money that you've put in? So obviously we've made contributions, and contributions we'll look at in a separate video because it is a topic on its own. So let us say we've built up some contributions inside the SSAS. And by the way, obviously, of course, the SSAS can receive transfers from existing personal pensions or SIPs that the individuals may already have. So they can transfer those in should they wish to do so. Very much your decision. Right, we're going to look at investing the money now, and let's have a look at the SSAS buying commercial property, which is probably the most common transaction we see inside SSAS. So we've built up funds inside the pension scheme with contributions and transfers. Let's assume in this example that the limited company actually owns the commercial property from which they trade. Again, this is probably one of the most common things we see. So I'm going to assume that this property has a value, and we always get everything independently valued. Let's say it's worth £300,000. It's sat on the balance sheet and it has debt on it. It has debt of £100,000. So they have a mortgage in the company on which they're paying interest and capital back so to the bank each month. So they've put money in the SSAS, they've had transfers come in. So let's assume that with the transfers that they've brought in and the contributions that have been made for the directors from the company over perhaps a couple of years or so, let's take this and say that each director has a SSAS value of £180,000. So their accountant perhaps has spoken to them and said, guys, I think you should look at this. It would be ideal to potentially take this property off the balance sheet and buy it into the SSAS. So the process is actually relatively straightforward. We get the property valued. In this case, it's worth £300,000, and it is always a red book valuation. We know we've got more than £300,000 in the SSAS, so we have obviously money for expenses because it does cost to buy the property. So we have a cumulative value in here at the minute of £360,000 in cash. So we decide to buy the property, and obviously that's a process of going through a valuation and a normal conveyance. So it's the solicitor who will arrange to convey the property from the company to the SSAS. So that process proceeds, and eventually we end up with the £300,000 property in the SSAS. But guess what? We're buying it from the company, so the money spins around. So we're actually buying it. So 300,000 flows back up to the limited company. And in the process, as you would expect, the solicitor will pay off the £100,000 debt that the company owes. So now the company has got rid of its debt obligations to the bank, which I'm sure will obviously help improve their monthly cash flow. But because we have now got the property inside the SSAS, it is the owner of the property. It is the SSAS that owns the property. It always owns all the assets that you put in here. The company now has to pay rent to the SSAS. So that is rent. And let us say in this particular example, the rent at an 8% yield wouldn't be untypical. So the rent would probably be around £24,000 per annum would be coming in to the SSAS. Don't forget that rental payment from the company is a fully corporation tax deductible expense, and you didn't have that in the debt. When you were paying the debt back from the company, only the interest is tax deductible, the capital repayments are not. So you've immediately improved the tax deductibility of this payment going out compared to the loan payment. So there's a huge uplift. So again, if you're paying out £24,000 of rent and you are paying corporation tax at the rate of 25%, that will save the company rent of £24,000, and assuming the company pays tax at the rate of 25%, that is going to further save the company £6,000 per annum of corporation tax. So again, this has to be good. Don't forget that £24,000 is coming into the pension scheme gross. There is no tax on the rent. So in this case, because each director has an exact 50-50 holding, then the rent would be attributed to each director on a 50-50 basis. If the holding is different, then all we do is prorata the rent value to the holding inside the SAS. So in this case, we would add £12,000 of value each year to each individual SAS inside, each individual member's proportion inside the SAS. So you can see that will build year on year on year and going forward. You've seen the benefits from SAS. We would like to hear from you which of those benefits actually speaks to you the most. And do you know if there's anything else in UK finance that confers more benefits? Please leave a comment below. We'd love to hear from you.
Book a call with us via the link in the description below. If on a mobile device, simply hit the More button under the video title and pick a convenient time to speak. Feel free to share this video with others that may benefit on WhatsApp or in other online groups or channels. Like, subscribe and hit the notification bell for lots more SAS related content, and leave a comment if you found this video helpful. For more, visit onecrownpensions.com.